Welcome to the Deep Dive, where we cut through the noise and get you truly well informed. Today, we're trying to understand, really, the financial heartbeat of a major institution. How does a company like M&T Bank navigate, constantly shifting economic waters, complex regulations, evolving customer needs? It's a huge challenge.
It really is. And for this deep dive, we're cracking open M&T Bank Corporation's 2024 Form 10-K. That's their big annual report.
Hmm.
Now, M&T, for anyone maybe less familiar, is a pretty significant financial holding company. They operate mostly across the Northeast and Mid-Atlantic here in the U.S.
Right.
Our goal today, our mission, if you like, is to pull out the crucial insights from this report, give you a clear picture of M&T's core business, its financial health, how they're trying to create shareholder value, and importantly, the challenges and opportunities ahead. Is its pulse strong, or are there maybe signs of strain?
That's a great way to put it. Okay, let's start by listening to those individual rhythms inside the bank, its business segments. These aren't just labels, right? They define how the bank actually serves its customers. What are these core segments?
M&T operates through three main reportable segments. Each one is really tailored to specific customer groups.
Hmm.
First up, you've got the commercial bank. This is all about serving those middle market and larger commercial customers.
Okay.
Think commercial lending, equipment leasing, uh, big commercial real estate credit facilities, CRE as it's known. They also do letters of credit, deposit products for businesses, cash management services, all that essential stuff.
Okay, and on that commercial side, any big shifts in their loan books, say 2024 versus 2023? I'm thinking especially about real estate and industrial loans given, well, everything going on.
Absolutely. Yeah, there were some notable changes. In 2024, the commercial bank actually saw average permanent commercial real estate loans decrease by about $3 billion.
Hmm.
And average construction loans, those were down too by $1.2 billion.
So pulling back a bit there.
Seems like it. It's likely a strategic move, probably aiming to de-risk a bit from commercial real estate, especially office spaces in this kind of volatile interest rate world. But on the flip side, average commercial and industrial loan C&I loans, those actually increased. And that growth was pretty broad across most industry types.
Interesting. So managing risk, maybe being a bit cautious on CRE, but still seeing opportunity in general business lending.
Exactly. It shows they're actively managing that risk profile. Cautious, yes, but opportunistic too.
Okay, so that's the big business side. But M&T also serves, everyday people and small businesses. How did that part of the bank, the retail bank, fare?
Right, the retail bank. That segment handles consumers and small businesses, mostly through their branch network, but also phone, online banking, ATMs, across their footprint in the Northeast and Mid-Atlantic. They offer the usual deposit products, car loans, recreational finance loans, which is an interesting growth spot we should maybe touch on. Home equity, credit cards, mortgages.
Yeah, you mentioned recreational finance loans saw growth. That's quite specific. Can you put some numbers on that?
Yeah, it stood out. Average consumer loans in the retail bank overall went up by $2.1 billion, reaching $22.5 billion in 2024. And a big chunk of that increase, $2.0 billion, came directly from those recreational finance loans. Boats, RVs, that sort of thing, presumably.
Huh. So they found a strong niche there, it seems.
Looks like it. It's clearly a target area for them.
Okay, and the third segment? Sounds like it serves a different crowd altogether.
That's institutional services and wealth management. This is where M&T handles more specialized stuff. Trustee services, agency work, investment management, admin support. This is for corporations, institutions, and high net worth individuals and families. They also offer mutual funds, annuities, other investment products. Oh, and just quickly, M&T does have some international activity, mostly trust services in Europe, but it's tiny. Less than 1% of assets and revenue. Their focus is really domestic.
Got it. So we know what they do, but how did they perform? 2024 versus 2023? Any surprising trends in income for these segments?
Yeah, there were some definite trends. For the commercial bank, net income actually dropped. It went to $871 million, down from over $1 billion, $1.04 billion in 2023. A big reason was that their net interest margin got squeezed.
Ah, the spread.
Exactly.
Yeah.
The difference between what they earn on loans and pay on deposits, it narrowed on both sides, even though average deposit balances actually went up. Now, their non-interest income fees and such, that did increase a bit, helping offset some of the pain. But expenses were also up, driven by allocated costs and personnel.
That margin compression, yeah, that's the story for so many banks right now, isn't it? The cost of funding just rising faster than loan yields?
Precisely. The Fed's actions really put pressure there. How about the retail bank?
How do they do?
The retail bank actually saw a non-interest income increase by $48 million. A big driver was higher fees from servicing residential mortgages. That benefited from a large bulk purchase of servicing rights they did back in early 2023. Remember that $19.5 billion portfolio?
Oh, right. That purchase paid off in fees then.
Seems so. And they also got more from service charges on deposit accounts. But like commercial, their non-interest expenses also climbed, mainly from those centrally allocated costs again.
Okay. And institutional services and wealth management. I imagine wealth management had some moves, but wasn't there a big one-off event last year that would affect the comparison?
You're right on the money there.
Yeah.
Their net interest income in this segment actually went up $48 million, but the non-interest income, that dropped significantly by $196 million. And the main reason, as you guessed, was the absence of that big $225 million pre-tax gain they got from selling their CIT business in Q2 of 2023.
Right, that sale. So the tough comparison year over year on that line.
Exactly. It really shows how a single large transaction can swing the reported numbers. Now, that drop was partly offset by better performance in their ongoing trust business, about $54 million higher, and also brokerage services income was up $19 million, mostly from annuity sales.
Okay, so that divestiture definitely shadows the non-interest income comparison. And speaking of strategy, M&T has a history of growing through acquisitions. Is that still part of the plan?
Oh, absolutely. The 10K makes it clear. They consistently look at acquiring other banks or related businesses. It's baked into their strategy either to complement what they already do or to expand where they operate. They've done it before, and they state they intend to keep looking. It's very much part of their playbook.
Okay, we've heard the individual rhythms of the segments. Let's zoom out now. How does this all add up to the bank's overall financial health? What do the headline numbers for 2024 tell us? And crucially, why did they land where they did?
Right, the big picture. M&T Bank's overall net income for 2024 came in at $2.588 billion. Now, that's actually down about 6% compared to the $2.741 billion they posted in 2023.
Okay, a 6% drop. Let's unpack that. Net interest income is usually the engine room for a bank like this. What happened there?
It really is the engine room. And yeah, their taxable equivalent net interest income decreased. It was down $267 million, landing at $6.9 billion for 2024. And the why comes back to what we talked about earlier, that net interest margin, the spread. It got squeezed by 25 basis points.
0.25%.
Yep, fell to 3.58% from 3.83% in 2023. And here's the core issue. The rates M&T had to pay on its interest-bearing liabilities, things like deposits and borrowings, went up faster by 57 basis points, actually, than the yields they were earning on their assets, like loans, which only rose 24 basis points.
Ouch. Cost of funds rising much faster than asset yields.
Exactly. And you can trace that dynamic pretty directly to the Fed's rate hikes in 22 and 23, and then the slight easing later in 24. It shifted the whole playing field. We also saw their average interest-bearing deposits grow by 9% and average borrowings jump 19%. So the funding mix was changing too.
Okay, so that core profitability from lending got squeezed. What about the other side of income, non-interest income, the fees?
Right, non-interest income. That declined by $101 million, or about 4%, down to $2.43 billion. And the big headline there, again, is the absence of that $225 million gain from the CIT business sale back in Q2 2023. That was a one-off boost that just wasn't there in 2024.
Making the comparison look worse.
Precisely. Though it's worth noting the decline was softened a bit by increases elsewhere. Service charges on deposit accounts were up, trust income unrelated to CIT was up, mortgage banking revenues improved, and brokerage services too. So underlying fee generation showed some strength.
And expenses. Did they manage to pull back on spending to help offset some of this pressure?
They actually did. Non-interest expense decreased slightly by $20 million to $5.36 billion. That's a positive. The main driver for the decrease was significantly lower FDIC special assessments. That was a huge swing, only $34 million in 2024 compared to nearly $200 million, $197 million in 2023.
Wow, that's a big difference on assessments.
Huge. And they also saw reduced costs for professional and other services. But it wasn't all savings. Those were partly offset by higher spending on salaries and benefits and also on outside data processing and software costs, investing in people and tech, essentially.
Makes sense. And I guess the tax rate played a role, too.
It did. Their effective tax rate dropped to 21.8% in 2024, down from 24.3% in 2023. That was mainly due to some discrete tax benefits, about $31 million worth, coming from tax credits and also sorting out a tax matter related to the People's United acquisition from a couple of years back.
Okay. Let's shift from income to the balance sheet. How did their assets and liabilities look at the end of 2024 compared to 23? Any major changes reflecting those strategic moves we talked about?
The overall balance sheet size was pretty stable, actually. Total assets ended the year around $208.1 billion, almost flat compared to 2023. Loans and leases, net of allowances, ticked up slightly to about $133.4 billion. What's quite interesting, though, is the allowance for credit losses. That's the pot of money set aside for potential loan defaults.
The rainy day fund.
Kind of, yeah. That increased to $2.184 billion. They specifically noted making qualitative adjustments, basically adding a bit more cushion, for exposures to certain C&I borrowers, CRE office properties, and those recreational finance loans we mentioned earlier.
So proactively building reserves where they see potential weakness. Makes sense. What about the funding side, deposits and borrowings? How did that mix change?
Total deposits actually decreased slightly, down to $161.1 billion. But there was a really interesting shift within deposits, especially broker deposits. Those are the large deposits banks gather via third-party brokers, often less stable than core customer deposits.
Right.
So while their regular savings and interest checking deposits grew, their brokered time deposits dropped sharply from $6.1 billion down to $1.0 billion as those matured. This definitely points to a strategic shift in wholesale funding, maybe focusing more on core relationships. And on the borrowing side, short-term borrowings went way down, but long-term borrowings jumped significantly, up to $12.6 billion from $8.2 billion.
Shifting to longer-term debt. Why do that?
It's a strategic move, partly to diversify their wholesale funding, make it less reliant on short-term markets, and also, importantly, to prepare for proposed new regulatory requirements around long-term debt for banks of their size. Shows they're looking ahead.
Okay, so managing the funding mix carefully. How does all this leave their overall capital and liquidity position? Those are key measures of resilience, right?
Absolutely crucial. M&T relies heavily on its core customer deposits, which is generally seen as a stable, lower-cost funding base. That's a strength. Beyond that, they have access to liquidity through broker deposits, borrowing from the Federal Home Loan Bank and the Fed, and tapping capital markets. They maintain a specific liquidity buffer cache and easily sellable securities designed to cover outflows during a hypothetical 30-day stress period. A safety net.
And capital requirements.
As a Category 4 bank, over $100 billion in assets. But below some higher thresholds, they have specific capital rules under Basel III, plus they undergo stress tests. Their specific supervisory capital buffer, or SCB, that's an extra capital cushion regulators require, became 3.8% effective October 1st, 2024. That brings their minimum common equity tier 1, or CET1, capital requirement up to 8.3%.
Okay.
And here's a striking figure. The parent holding company's own liquidity position, including expected repayments from its bank subsidiaries, was enough to cover its projected cash outflows for 44 months at the end of 2024.
44 months. That's quite a cushion.
It's a very significant buffer, suggests strong financial resilience at the parent level.
That's definitely a solid buffer. Okay, so that brings us neatly to how all this financial management translates into value for shareholders. What's M&T doing to reward its investors?
They have a clear focus on returning capital. Two main ways: dividends and share repurchases or buybacks. On the buyback front in 2024, they repurchased about 2.1 million shares for $400 million. That works out to an average price of roughly $184 per share. The year before, 2023, they bought back even more, almost 3.8 million shares for $600 million.
So actively buying back stock, what's the latest plan there?
They just announced a new program. On January 22, 2025, the board authorized a fresh $4.0 billion common share repurchase program. This actually replaces the previous $3.0 billion one, so it signals a pretty strong ongoing commitment to buybacks. Of course, these things are always subject to regulatory approval and depend on their capital levels, liquidity, and needs for funding loan growth, but the intent is clear.
$4 billion is a substantial authorization. What about dividends? Often the foundation for bank stock investors.
Definitely a key part of their strategy. Historically, the money for dividends paid by the parent company mostly comes up from its subsidiary banks. As of the end of 2024, those banks had about $2.3 billion available that could potentially be paid up to the parent company as dividends. But, and this is important, paying those dividends is subject to Fed oversight. They have to maintain those minimum capital ratios, including the SCB we discussed. If that buffer requirement goes up, it could restrict distributions. They also need prior approval sometimes, like if they have to resubmit their capital plan after a big acquisition. So It's shareholder return, but always balanced with regulatory constraints.
Right, always that balance. Okay,
Yeah.
we've looked inside M&T at the finances, the shareholder returns. Let's look ahead now. What are the big rocks in the road, the major challenges, and also the opportunities for M&T going forward? How resilient do they look?
Well, the challenges are certainly real and varied. First off, they're obviously exposed to the broader economy. Any weakness, recessionary pressures, geopolitical shocks, inflation, all that impacts them directly. And interest rate volatility remains a huge factor. Changes in rates, the shape of the yield curve, it massively impacts their profitability and the value of their assets and liabilities. We saw that play out clearly in 2024.
Yeah, the rate environment is key. And regulation, you mentioned it's always changing.
Oh yeah, it's a constant. They operate under a complex web of federal and state rules. Basel III updates, tailoring rules, Dodd-Frank fallout, compensation rules, resolution planning. It's a lot. New rules or stricter enforcement can raise costs, limit what they can do, hurt competitiveness. Those proposed changes to capital rules and long-term debt requirements. They're still evaluating them, but they could mean higher costs and potentially affect capital returns down the line. It's a significant headwind.
What about the loans themselves? Any specific worries about credit quality?
Credit risk is always there. They have significant concentrations in commercial real estate and also C&I loans, particularly in their core Northeast and Mid-Atlantic markets. Now, there was some improvement. Noted investor-owned CRE loans as a percentage of criticized loans actually fell from 70% to 61% year over year, which is positive. But real estate values can be tricky, very sensitive to market shifts. So it's an area they have to watch constantly.
And liquidity, always critical for a bank.
Absolutely. They need reliable funding sources. While core deposits are a strength, any major market disruption or hit to customer confidence could squeeze liquidity and push up funding costs. It's a perpetual management challenge.
And then the operational gremlins and cybersecurity.
Yeah, operational risk, human error, system failures, external events, it's always present. And cybersecurity. That's a massive and growing threat. They rely heavily on their systems and third-party providers, too. They mentioned the MoveIt incident in 2023 affecting customer info via a vendor, though M&T's own systems weren't breached. They have a risk framework, security controls, employee training, phishing simulations, but the threat from sophisticated attackers, ransomware, supply chain attacks, it's just incredibly high. And new state regulations, like in New York, are constantly adding more requirements.
It's an arms race, basically. And what about newer risks like climate change? How does that factor in for a bank?
It's definitely factoring in more and more. There are growing expectations from regulators and stakeholders about managing and disclosing climate-related risks. This means developing new risk practices, potentially facing higher costs, and maybe even dealing with conflicting rules in different places. It's a complex, evolving area they need to navigate.
Okay, so a lot of challenges, but it sounds like M&T also has some real strengths internally, particularly its people.
They really emphasize that. They call their employees nearly 22,000 full-timers at year-end difference makers. They invest quite a bit in attracting and keeping talent. Engagement surveys show high participation. They have development programs, good benefits. And look at the tenure. Average employee stays 9.6 years. For executive officers, it's over 15 years. That suggests a pretty stable, experienced workforce and maybe a strong internal culture. That's a definite asset.
That kind of experience is valuable. And finally, just underpinning everything, their internal controls.
Foundational, really. Management assessed their internal controls over financial reporting as effective at the end of 2024. And crucially, that assessment was audited by their external auditors, PwC. That independent check provides essential assurance about the integrity of their financial reporting.
Okay, so recapping this deep dive, M&T Bank seems to be navigating a really complex environment. They're balancing strategic growth, like focusing on C&I, keeping acquisitions on the table with the need for financial discipline, especially with rates where they are, and all while showing a strong commitment back to shareholders through those buybacks and dividends.
Exactly. And underpinning it all is that constant focus on risk management, whether it's credit risk and specific loan types, the huge challenge of cybersecurity, or these newer, evolving risks like climate. Their experienced workforce and solid internal controls seem like key pillars supporting them through all this turbulence.
You know, all of this makes you wonder, how does a bank like M&T, with such deep roots in traditional banking, keep adapting and thriving as finance gets more digital, more AI-driven, especially with cyber threats getting smarter and regulators pushing on new fronts like climate risk? What innovations might we see next that could really redefine what a bank even is in the coming decade? It's a fascinating question, I think, for the future of M&T and the entire industry.